Assalamualaikum and hi everyone. Today we want to present about Kawan Food Berhad Financial for course DPB 40123 Business Finance. Let me introduce our team members. My name is Izati Shamimi binti Ibrahim, metric number 01DRM 23F1042, and my other members which is Nur Alia and Nur Dania Afrina. As you can see, here's some agenda that covered in this report. First, highlights and key updates. Second, timeline. Third, remaining time. Fourth, revenue. Fifth, cash flow. And lastly is latest information. Before that, let me talk about the introduction of this report. This report analyzed the financial performance of Kawan Food Berhad for the years 2022 and 2023 based on data provided in Appendix 1. The analysis focused on four key areas, which is liquidity, efficiency, leverage, and profitability. The purpose is to evaluate the company's financial health, identify strengths and weaknesses, and suggest improvement to support better financial management in the future. So let me start with the liquidity ratio. The first is current ratio. For the liquidity ratio, Kawan Food Group has shown very strong performance. In 2022, the current ratio was 4.36 and in 2023 it slightly decreased to 4.34. This means the company had more than Rm4 in current asset for every Rm1 of current liabilities. It shows the company is more than capable of covering its short-term debts. As you can see, there is a formula for current ratio. Current ratio equal to current asset divide current liability. For the current ratio 2023 equal to 237,104,897 divide into 54585,229. So the answer is 4.34. Next, for the current ratio year 2022 equal to 223,338,825 divide into 51,239,850 and the answer is 4.36. Second of liquidity ratio is quick ratio. As for the quick ratio, it increased from 3.54 in 2022 and 3.68 in 2023. This indicates the company can still cover its short-term liabilities even without relying on inventory. Overall, the company's liquidity position is very healthy. The formula for quick ratio is quick ratio equal to current asset subtract to inventories divide by current liabilities. For the quick ratio 2023 equal to 237,144 237,104,897 subtract 36429,562 and divide by 54,585,229. And the answer for this calculation is 3.68. For the quick ratio for the year 2022, 223,338,825 subtract to 42033,804 divide by 51,239,850 3.50, and the answer is 3.54. Next is efficiency ratio. First of efficiency ratio is average collection period, ACP. For the average collection period, there was a slight decline in performance. In 2022, the collection period was around 96 days, and in 2023, it increased to 100 days. This shows the company is taking a bit longer to collect payments from its customers. This situation could affect cash flows and should be monitored by the management. The formula for ACP equal to trade receivable divide into revenue and multiplication 365 days. Let me see the calculation for ACP 2023. SAP 2023 equal to 78682,061 divide into 287,215 and 315 and multiplication into 365, and the answer is 100 days. Next, for the ACP 2022 equal to 72547,213 divide into 274,761,875 and multiplication 365 day, and the answer is 996.4 days. Next, inventory turnover. As for inventory turnover, the company showed an improvement. In 2022, inventory turnover 4.56 times in a year, increasing to 5.63 times in 2023. This means stock was sold more quickly, indicating more efficient inventory management. This positively impacts the company cost control and cash flow. As you can see, the formula for inventory turnover equal to cost of sale divided by inventories. The inventory turnover for year 2023 equal to 205,148,099 divided by 36,429,562, and the answer is 5.63. For inventory turnover for the year 2022 equal to 191,684,230 divided by 42,033,804, and the answer is 4.56. So that's all from me, and I will pass to my friends.
Assalamualaikum. My name is Alia binti Azhar. My matrix number is 01 DRM 23F1011. I am going to continue about recommendation. First one is current ratio. Although the ratio slightly dropped, it is still very healthy. The company should continue to maintain this strong liquidity position, but also ensure that excess current assets are used effectively, perhaps by investing in short-term opportunities rather than letting them stay idle. Next, quick ratio. Since the quick ratio improved, the company is moving in the right direction. However, it can further optimize cash flow by shortening the collection period from debtors and keeping tight control on receivables. Next, we have average collection period. The company should improve collection efficiency by revising credit terms or offering early payment incentives to customers. This will enhance cash flow and reduce dependency on external funding. Lastly, we have inventory turnover. Continue improving inventory control and demand forecasting. Efficient stock management reduces holding costs and increases responsiveness to market demand. Okay, next we have efficiency ratio, fixed asset turnover. This ratio measures how efficiently Kawan Food Berhad use its fixed assets like factories, equipment, and others to generate sale. The increase from 1.31 to 1.46 shows that Kawan Food Berhad improved asset usage in 2023. It generated more sales per ringgit of asset, a positive sign of operational efficiency. The formula is fixed asset turnover, revenue divided net fixed asset. 2023 equal to 287 to 15315 divide 195,99922 and 1. 2023 equal to 1.46. For 2022, 274761,875 divide 210,392,802 equal to 1.31. Next, we have leverage ratio, debt ratio. This ratio tells how much of the company's total assets are financed using debt. Kawan Food Berhad had very low debt in both years, although the ratio increased slightly in 2023 from 14% to 15%. The company still relies mostly on its own capital and has low financial risk. The formula for debt ratio is total liabilities divide total assets. 2023 equal to 675,90948 divide 4607567709 equal to 15%. For 2022, 639,42558 divide 460,810,382 equal to 14%. Next, we have debt to equity ratio. This shows the relationship between the money borrowed and the owner's money. A ratio of 0.17 means that for every 1 ringgit of equity, Kawan Food Berhad only has Rm0.17 of debt. The increase is very small. Kawan Food Berhad remains financially strong and stable, not highly geared. Debt to equity ratio formula is total liabilities divide total equity. For 2023, 675,90948 divide 393,165,761 equal to 0.17 or 17%. For 2022, 639,42558 divide to 396,867,824 equal to 0.16 or 16%. Next, we have times interest earned. This ratio shows how easily Kawan Food Berhad can pay its interest on borrowings. In 2023, Kawan Food Berhad could pay its interest 166 times over, up from 129.5 times in 2022. This shows excellent financial health in the company is not under pressure from its interest costs and has strong operating profits. For the formula of time interest earned is profit before interest and tax divide interest expenses. 2023 equal to 342,66322 plus 207781 divide 207781 equals to 166 times. For 2022, 401 plus 312 divide to 312323 equals to 129.5 times. Next, for profitability ratio, gross profit margin. The gross profit margin indicates the percentage of revenue that exceeds the cost of goods sold. In 2022, for every RM1 of sales, Kawan Food Berhad made RM0.3025 in gross profit. This dropped to RM0.2857 in 2023, indicating slightly higher production or raw material cost. This decline could be due to inflation in ingredients, increased packaging costs, or inefficiency in manufacturing. Even a 1 to 2% dip in this margin can significantly affect overall profits, especially for a high-volume food manufacturer. Kawan Food Berhad should consider reviewing its supply chain contracts and improving operational efficiency to protect this margin. Gross profit margin formula is gross profit divide revenue times 100. 2023 equals to 820,67216 divide 287,216,315 times 100. 2023 equals to 8.57%. For 2022, 830,77645 divide 2747,61875 times 100 equals to 30.25%.
Hello, my name is Nodana Afrina binti Muhammad Fuad, no metric 01DRM23F1044. Today I will talk about profitability ratio. First is net profit margin. The net profit margin reflects the company's ability to convert revenue into actual profit after all expenses, including taxes, administrative costs, and interest. In 2022, Kawan retained 40 cents for every RM1 in sales. In 2023, this fell to only 10 cents. This indicates that operational costs such as marketing, logistics, or overhead have risen faster than sales. A net margin above 10% is still good for the food industry, but the downward trend is a warning. Management should consider cost reduction strategies, optimize marketing spending, or streamline logistics to recover profitability. Second is return on asset. Measure how efficiently the company uses its total asset to generate profit. A decline from 8.35% to 6.54% means the company is generating less income from each ringgit invested in asset. This may point to underutilization of machinery, inefficiency, factory output, or excess idle assets. For Kawan, whose operation depends heavily on manufacturing facilities, improving machine efficiency, reducing downtime, and ensuring proper asset maintenance could help boost. Lastly, for profitability ratio is return on equity. Show the return earned on shareholder investment. In 2022, for every RM1 of equity, the company earned 0.097 cents in profit. This dropped to RM0.0766 in 2023. A falling ROE suggests shareholders are getting less value from their investment. This may discourage future investors. The drop could be due to lower net profit or a rise in retained earnings without proportional profit growth. Kawan must work on improving profitability and may need to consider shareholder focus strategies such as dividend consistency or equity restructuring if underperformance continues. The recommendation for gross profit margin is first, renegotiate supplier contract to reduce raw material costs and improve production efficiency through automation and better waste control. Lastly, strengthen inventory management to avoid overstocking or product spoilage. For net profit margin, review and reduce overhead costs such as utilities, outsourced service or excess staffing. Focus marketing on digital platforms which are more cost-effective and traditional advertising. Lastly, implement strict budget control across departments to avoid unnecessary spending. Third, recommendation for return on asset. Maximize asset utilization, ensure all equipment and facilities are used efficiently. Dispose or repurpose idle assets that do not contribute to revenue. Lastly, consider investing in higher return projects instead of tapping out funds in low performing assets. Recommendation for return on equity is increase net profit by reducing costs and increasing efficiency, maintain transparent communication with shareholders about recovery plans, consider strategic dividend or buyback program if cash flow allows to improve equity performance. In conclusion, Kawan Food Berhad maintains strong financial stability in both 2022 and 2023. The company showed excellent liquidity and a low level of debt, which means it is financially healthy and capable of meeting its obligation. However, its profitability declined in 2023 compared to 2022, with lower profit margin and return. The average collection period increased, which may affect cash flow, and operating costs remain a challenge. Despite these issues, Kawan improved its efficiency in using assets and managing inventory. To continue growing, Kawan Food should focus on improving profit margin, speeding up customer payment, and controlling costs. With this improvement, the company can strengthen its financial performance and competitiveness in the market. Thank you. That's all from us.